Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you annuity withdrawals for beginners. And what are the different ways on how somebody could take out annuity payments in the form of withdrawals and some of the mistakes to avoid throughout the entire process. Now, the earlier stages of annuities would be something known as annuitization. And essentially what would happen is annuity contracts were supposed to counteract life insurance. So as somebody would place money into a life insurance policy, they would be placing smaller premium dollars. And what it would do is give this person coverage in case they died too soon, meaning if they passed away before retirement or they passed away before a debt was paid off, whatever the case may be, they could or they want to leave an inheritance or a legacy to their loved ones. Whenever that person passes away, a lump sum is then gets paid out to their beneficiaries. So annuity payments are the complete opposite of that. What it does is an individual would give a lump sum amount to an insurance company. Understand that insurance companies the only type of carriers that could offer an annuity contract. Just like a bank CD, only banks could offer, CD type contracts. So it has to play within their levels, within those lanes of an annuity contract could only be offered through the insurance company. A bank product obviously could only be offered through a bank. So with these annuities, what an annuity does is someone's giving a lump sum dollar amount to an insurance company. That insurance company is making a calculation based upon how old that person is, and they're saying, okay, based upon our computation, based upon your age, based upon what our current rates are, we're going to provide you lifetime income for either yourself or you and your spouse for as long as you live. So if somebody's younger, well, then they're going to have a smaller amount of payments on a monthly basis or on an annual basis than somebody that's older. Reason being is the insurance company could give a higher offer to the older person because they understand that that person's closer to death. So therefore, they might only be receiving 12 years worth of payments based upon those mortality tables, based upon the statistics set up through the insurance company for somebody that's 65 years old, as opposed to somebody that's 60 years old might be getting $1,000 less a year or $2,000 less a year from that same dollar amount that they're placing with that company. So the problem that lies there is something known as annuitization, because from one aspect, the individual is going to trigger off and purchase that annuity contract because they're going to receive lifetime income from the company, right? The downside is whenever that person passes away, depending upon how they set up that lifetime income payment, most of the times through annuitization, there's not going to be a death benefit left to beneficiaries. So if you're going with something known as a single life only option or a joint life only option, what happens is a person could go take $100,000, place it with an insurance company, and let's say this person's 60 years old, and the insurance company is making an offer of saying, okay, $6,000 every single year to the day that you pass away, we're going to provide you $6,000 per year. So let's say if this person only lives 2 years and unfortunately passes away, well, the insurance company only paid out $12,000, and they get to now walk away with 88 grand of pure profit. So the insurance companies they're going to try to give individuals a large incentive to annuitize your contract, because they want to keep as much control of your money as possible. So that's why individuals started leveraging annuity product lines. So they started seeing through the lines of saying, well, I kind of want to make sure if I earn this money, if I saved up for this money, and yes, I understand that I'm receiving a retirement paycheck, kind of like a pension plan. I do not want to something, God forbid, I pass away too soon. I don't want the insurance company to keep all my money. So that's why you had a really large knock against annuities, and I think it's definitely warranted because of the fact that insurance companies were trying to keep those individuals, that they were trying to keep control of the money and play by the games of annuitization that would eliminate a type of inheritance left to beneficiaries. Now, since that point in time, you had the 80s, the 90s, the 2000s. The more recent times, you had innovations to these types of annuity product lines. So if someone's looking at like a fixed interest annuity, such as an index annuity or just a regular fixed annuity, what they can do is live off of the interest that they're gaining year by year to use it for lifetime income or to use it for income for that year. So if someone, let's say, threw $100,000 into a type of fixed annuity, and right now, unfortunately, interest rates have hit all-time lows, so you don't have as many people that are placing money into fixed annuities as they once were. Let's say the best contract comes back at a 3%, interest credit. So what this person could do is say, okay, I'm going to live off of $3,000 every single year off of my $100,000 investment. Maybe this is a 5-year product. after 5 years, or after everything's all said and done, after those 5 years, I would have taken out 3,000 every single year, and then I would be able to walk away with my principal again of 100 grand. Or you could use an index annuity that says, okay, well, I'm either going to be receiving a gain into my account, or I'm going to be receiving an interest credit that's based upon an upward stock market index, or I'm going to receive a 0% gain into my account. So that's kind of the risk. Rather than a flat interest rate, an index interest rate could allow somebody to have a double-digit gain in a given year, or a 7% gain, 8% gain in a given year. That could be the equivalent of 2 or 3 years of a fixed rate that's currently being paid. So there's some pros and cons with each of those types of contracts. Understand that there is a way on how to take annuity withdrawals in the form of interest credit only, to make sure that it's sufficing your particular goal. The secondary portion, when I'm saying lifetime withdrawals, you had something known as income riders that came out in early 2000s. They were set up through variable annuity contracts that essentially said that, okay, rather than annuitizing your money, what we're going to do is have this additional feature for a cost known as an income rider. So if somebody has a variable annuity, we understand that variable annuities are tied to mutual funds. So if you're thinking of your account in the form of a type of bucket, well, you have different types of costs associated with the variable annuities that are typically more expensive than a typical, just mutual fund brokerage account. Now, the main reason why someone would want to do that is for this income rider play for lifetime income without losing control of their account value. So in the early 2000s, variable annuities became very attractive because of this income rider play. And what they would do is they'd say, okay, if the market goes up, well, then you're going to have gains into your account. If the market goes down, well, then your account's going to be severely reduced as well. So individuals could therefore place their money in a variable annuity, understand that they're getting gains or losses into their account, but they're placing it in there specifically for this income rider aspect to say, I'm placing my money in here. I want to turn on income immediately, or I want to return on income in a couple of years. I want to have a specific dollar amount that's coming to me year by year by year that I could never outlive, or me and my spouse could never outlive. So that's how they're able to leverage the lifetime income rider rather than utilize annuitization. The major difference there, and let me clear off the script, the major difference between annuitization and income rider is if somebody annuitizes their contract, they're surrendering complete control of their money to the insurance company. With the income rider, they could still have control off of their account value, off of their money still going to be growing whenever the markets go up, or dependent upon whatever account that they're invested in. But the income rider allows them to receive lifetime income, but God forbid if they were to pass away, like that individual with that 2 years, he died after 2 years, if he still had $88,000 into his account value, then that money would then be left to beneficiaries. So variable annuities, there's a large knock on variable annuities because you had an exorbitant amount of fees, and what the underlying premise from the insurance company was to try to tack on all these fees to get your account value as fast as possible down to $0, so that yes, you're still providing a lifetime income, but it's just like the same thing as annuitization, that same commonality and that same negative as annuitization. So that's why after 2008 you had these product lines known as hybrid annuities that came out that leveraged something known as a fixed index annuity, and it stole that idea of the income rider, but now you have a more consistent basis on your account. You have a lot less fees. In some cases you have zero fees tied to your account. So it allows your account value to gain whenever the market goes up, not lose anything whenever the market goes down on your actual physical money. And then on top of it, you have the income rider that allows you to provide lifetime income year by year by year. If your account value hits $0, well, then you don't leave anything to your beneficiaries, but the insurance company is still on the hook to pay you that lifetime income. So these are the different things that you have at your fingertips when leveraging an annuity contract, and also utilizing withdrawals through an annuity that you have to be mindful of, because there's many times that individuals get placed into an annuity contract when it is not the correct fit for their specific situation. They might not be interested in lifetime income or any income in that matter, and the person has just been essentially penciled into an annuity contract and was not fully educated on what they have, or what are the pros, what are the cons to these types of contracts. The number one takeaway from this video and from all the videos that I send out there is to customize your plan properly. Understand that you have hundreds of different carriers that have multiple different contracts that are available to you. So rather than hearing something, a radio advertisement, you saw a television commercial, whatever the case may be, you don't want to just go to a random company and place your dollars with them. And the reason being is because then the key component, the key word there is leverage. You want to make sure if you're taking $100,000 or $1,000,000 or however you want to splice up that specific goal, make sure it's customized specifically to what your goal is so that you have the proper plan that will be able to provide you the most amount of leverage, the most amount of benefit. So if you have company ABC that is you're going to go place $100,000 in them and your goal is to wait 2 years before you're executing lifetime income, well, maybe company ABC might give you a $6,000 benefit as opposed to company XYZ that might give you a $7,500 lifetime benefit. So, everything's going to be relative specific to your situation, depending upon your area. There's going to be some carriers that offer, types of contracts as opposed to other carriers, depending upon what your income goal is or what your safe accumulation goal is. There's specifically designed contracts, properly for your benefit. But at the end of the day, you have to make sure that this is customized at all time. And this is one of the things that make us very unique is we leverage a process known as the Retire Sharp planning system, where on average, each person that calls into our office, first off, we're going to educate them. We're going to find out what their goals are and see whether or not an annuity might make sense to them. There's times that we don't leverage annuities. That if you want to have a lifetime income plan, there's times that you don't want to use an annuity for that process because it's going to restrict some of your liquidity. There's a reason why these companies are making you this offer. They're not just in it to be all, great people. They're in it to make money. So you have to dissect and see which criteria, depending upon your age, somebody that's in their 50s that has a specific goal is going to have 3 separate contracts that will come back most favorable than somebody in their 60s. So it's not just randomly throwing darts at a dartboard. It's being precise, making sure that you're scanning through all the companies. And this is what we do is we make sure for each person's situation we go through over the hundreds of different carriers, hundreds of different contracts, and multiple strategies, so that on average we go through over 1,200 different processes before we give our top 3 recommendations. We believe education is first. You have to understand exactly what you have so you're not making mistakes. You understand the pros, you understand the cons properly. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and we're available to speak with you guys 24 hours a day, 7 days a week. We implemented that a few years back. That allows us to talk to you mornings, nights, weekends, holidays, whatever the case may be, because at the end of the day, it's your retirement. This is your livelihood. This is as if you're getting on an airplane and you have a certain risk of that airplane not getting to your destination safely. That's the way you have to look at it. That's the type of protocol that you have to look at regarding your retirement process. And there's times that you could get set up from point A to point B and make sure that it's successful. There's other times that you could have a retirement disaster in there. So what we try to do is make sure we have all the carriers out there, the best strategies available to you, and we're going to try to educate you and help you out best way possible. Once again, my name is Derek Afasi. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.